Okay, you caught me. I told you I wasn't going to say anything about IIREC 2020 again, because after all, it's already happened. But I didn't quite tell the truth because I'm about to talk about it. You are about to get access to my keynote speech from IIREC 2020. In this, I talk about some of my biggest losses, though I don't have too many, and how I turned those losses, the lessons I learned, and how I repositioned those losses into some massive wins, and how I turned those losses into a $90 million portfolio through ASIM Capital. So I will let you jump right into the content. The things we're going to talk about are interesting, right? So first of all, like I mentioned, I, as you know, started my real estate company at a very favorable time to do it, but it's not what people think when it's, quote, the most favorable time in the history of the United States to invest in real estate. It is not like, oh my gosh, there's so much opportunity. Yay, we're so happy. I'll let myself fill in what that was really like. We'll talk about an emotional loss, which almost wiped me out before I even got started. We're going to talk about an investment which literally ended in me saying, you know what, keep the keys. I'm done. Can't do it anymore. Not going to do it. Thankfully, investor capital was not involved. I literally gave the keys back on an investment that I made many, many years ago. And some lessons learned from an excellent retail investment. I made an investment that I would make that investment today, and I'm confident the outcome is going to be quite good. But there was a little bit of a hiccup that took place during the investment, and I realized how I should probably position myself, or at least part of my portfolio going forward. Since I'm allocating a significant portion of my portfolio to the world of syndications, in fact, I think 80 or 90% of my net worth is in syndications. You're going to have a lot of investments. Diversification is key. Let's talk about how to accomplish that. Okay. Also, the CFC mentorship program. I mentioned it. We only accept 7 people per quarter. For Q2, we actually sold that out. We sold it out so quickly that we decided to open up another one during Q2. So we're going to run 2 simultaneous mentorship programs during Q2. The way it's structured, we have a group call every other week. There's also a robust video platform and some Facebook interactions, etc. But the point is the calls are every other week. So we're going to create a alternate mentorship program where the calls are the opposite every other week. And I feel like this is a great way to keep up with the demand. There's been a surge of interest because of the book, which is obviously incredible. I think generally speaking, there's a surge of interest. There's so many courses and programs and mentorships and masterminds out there. But from my perspective, they all are usually focused on a particular niche and they can serve their purpose. So if all you want to learn about is the RE business, this is not the program for you. If all you want to learn about is the self-storage business, this is not the program for you. But if you're interested in having a very thorough foundation and also at an elite level understanding of the entire real estate sector across multiple asset classes, across multiple structures, across multiple niches, in my opinion, there's nothing like it. And you've heard some of the reviews, I'm sure. So check it out, cfcmentorshipprogram.com. It's very likely that this one will sell out very, very quickly. So if you hear it, you've been sitting on the sidelines, you're interested in doing it, head over there, apply now, and my colleague Adam Carswell will reach out to you. All right, hope you enjoy the episode. Awesome. I would just play this whole song. This is the intro to my podcast, which I love this music. So we're going to talk about how I turned some big real estate losses. I don't have too many massive real estate losses, but I have a couple I wanted to share with you guys. But just for some context, I started my career in 2010, which was the opportunity of a lifetime, and that's at least what everyone talks about. So the reality was the story was very different. If you weren't in the business, it was not just like, oh my gosh, it's a great time to invest in real estate. What really it was like was every news article looked like this. Thanks in part to continued high unemployment, home foreclosures reached record levels in 2010. Industry experts say 2011 could be even worse if unemployment remains stubbornly high. It's the bleakest year in the foreclosure crisis has just begun. And that was really the beginning of my career. So for some perspective, only 100,000 homes were foreclosed in 2005. That number went from 100,000 to 1 million. That was kind of a problem that not a lot of people were dealing with to a problem that everyone was dealing with. Someone's cousin, someone's daughter, something like that. 2.9 million foreclosure filings at that time. And 250,000 foreclosures that were in some sort of litigation because the banks and the states and the financial regulatory agencies weren't even allowing these foreclosures to go forward. 5 states
Arizona, California, Florida, Illinois, Michigan accounted for more than 50% of all the foreclosures in the United States. So when I started my career, I was going to networking events and the mood was somber, right? A lot of people had just lost their shirt and it didn't feel like it was really the opportunity of a lifetime. But you basically couldn't lose. We know that now. Here's what this looked like. We're here at the bottom of this massive, massive trough, and I'm going to come back to this in a second. The reason I'm painting this picture is that I almost did miss this opportunity. I almost did lose in a big way. The one that almost wiped me out. It was a little counterintuitive, but this is a true story. So back then, 2010, there wasn't all the online component. The podcast world hadn't really caught on. The way that this whole community really was built was in-person networking events. It was the best way to learn back then. I would attend 3 to 5 every single week. I would drive in traffic. I would pay the $15 or $25, and I'd really start to build a reputation for myself. I would talk a lot during these meetings. I would ask a lot of questions, trying to kind of draw attention to myself, trying to build up a reputation. And that's really how my career got started. And so I established myself well known in the community, especially in the FIBA community, which I'm forever grateful for. So this business model, at the time, it was about building up your reputation and then creating your own in-person networking event. And that was really how, now I have a podcast. The structure was really focused on those in-person events. Mine was in West Hollywood. It was 15 minutes of networking, then 1 hour presentation led by me, then 15 minutes of networking. And I would probably bring 15 to 30 news articles that all looked like that, by the way. Not a lot of fun. The Caparatinis were flowing back then, trust me. 5 pages to print out, and I would talk about something like deal structure for downside protection. By the way, I wasn't really an expert quite yet. I just kind of saw what other people were doing, trying to mimic it. And so I could talk about it, but really I wanted to create a situation where people were learning, and I wanted to learn about downside protection myself, so I figured it was a good way to do that. So the first one was a massive success. 30 people came, and I actually have a photo of it here. There it is. That's how it felt, at least. I think this is actually a UFC event, but that's how it felt. When I walked in the room, it was full, and I was like, oh my gosh, yes, it's gonna work. My career is off to a great start. A ton of questions were asked. It was a great networking opportunity. Christina Suter, who just spoke, she drove from Pasadena for my first one, so thank you for that. And the following month, 4 people came. Okay, so this is a picture of that one. This was, Jeremy was there, and Steve Setledge was also there. So thank you, Steve, for showing up, and some other person that I don't remember. So if you're in the room, thank you as well. This was far worse than if 4 people came to my first one, and then the next one was 4 people or something. What happened was people came to the event. They realized, I could ask interesting questions at this event, but this person doesn't really know what he's talking about. I wasn't worth their time. People now have flown in from all over the country. I couldn't get someone to go from West Hollywood to West Hollywood. People were not coming. It was emotionally devastating, truthfully. I almost quit because of this. I had built this reputation up in my mind of being someone that should be listened to and stuff like that, and just almost wiped me out because I wasn't really there. I was 6 months or a year maybe ahead in my mind of where I actually was. So here's some lessons learned. If you're contemplating doing this, here's some lessons learned here. Number 1, don't try to be like everyone else. I made this networking event because I thought that that's what other people were doing. It didn't really speak to me personally, but I thought that it was a good model, so I just mimicked other people's events. Number 2, if you're going to create something like this, ensure that the schedule is replicatable and doesn't require too much of your time. See, the challenge was that it was all reliant on my understanding. I was the one leading the conversation. I was the one picking the topics. It's very, very burdensome to do that. So just keep that in mind if you want to do something like this. And of course, if you're getting started, center the expertise on someone else. If you want to create a podcast, for example, if you want to host an event, have experts come in and talk about their particular niche so that everyone can actually learn together. Remember that consistency is key. I did 3 of these, by the way. I did the first one, which is a success, did the second one, which almost wiped me out emotionally, and the third one was basically me, by myself. And it takes time to build something like this. So don't think that it's a short game, because it's totally not. But most importantly, many, many business ventures fail because people are not emotionally prepared for taking a loss. Like if you're just getting started and you haven't gotten punched in the gut yet, that can wipe you out. And think about that chart. That almost wiped me out at the most favorable time in the world to invest in commercial real estate or real estate. Okay, now let's talk about some real estate deals real quick. I'll talk about two. This is a 7.2% cap rate gone wrong. Raise your hand if you'd love to invest in a 7.2% cap rate right now. I would, by the way. If you have one, please talk to me after. Unfortunately, it looked like this. Okay, now the story changes. So this was a SFR operator I had invested with and worked with previously, referred to them by several investors. There was 3 properties. Cumulatively, they cost $120,000 and with a $30,000 rehab, so not in California, obviously. The operator actually guaranteed rental income day one. So they were buying a foreclosed property. They were going to fix it up for me, but they were going to start paying me as soon as the property was purchased. How can I lose? As soon as it's rented up, I'll start getting the cash flow. Sounds good. So here's how it went wrong. It was a $150,000 purchase price, $1,800 a month in rent. So take away the expenses, which are about half. You got about $10,800 of NOI. That converts to about a 7.2% cap rate. So I got a 70% loan to value at a 7% interest rate. This is a red flag, okay? I didn't understand really what was going on, but there's no real spread between the interest rate and the cap rate, and that doesn't even account for vacancy, let alone the stuff that we're about to get into. So that spread is really important. What that means is that you're very close to negative leverage, meaning that you're borrowing money at a rate that's more expensive than the rate that you're investing. You shouldn't do that. But it could take you time to actually figure that out if you haven't run these calculations. So another thing about this, though, is that it's not always just about the percentages. It's about the gross dollars, and I'll explain why. So we mentioned in the last panel debt service coverage ratio. So here's that calculation. The NOI divided by the debt service. That was the $7,000 figure there. That's the annual payment of my loan. So the debt service coverage ratio is reasonably conservative, 1.47 or so. So that's like a reasonably conservative debt service coverage ratio, but it doesn't paint the whole picture. The challenge is that it was only $3,400 a month in positive cash flow. So what really happened was I had to go to Jackson, Mississippi once, which is where the property was, $1,500. There was a stolen air conditioning unit because it was in a bad area, $3,800. There was vandalism that cost me another $1,000, and so that NOI that was supposed to be 10 grand was negative 2850. And that doesn't even account for this potential situation with the negative leverage situation that I was talking about. So, one more point. The property manager company with percentages, they charged about 8% of gross income. That's a market rate, okay? But again, it's not just about the percentages. Take a look at the numbers. 8% of $2,100 of gross is like $144 a month. So the question is like, what kind of talent can I attract for $144 a month to manage 3 properties? I'm entrusting this $150,000 purchase with someone who's making $40 per property. So where are they gonna be in terms of like their competency? You know what I mean? In terms of, should I entrust my entire investment with them? Well, what happened was I lost the entire down payment. I eventually didn't even put together what was going on with the interest rate, but I basically said, this is not working after 2 years. Here's the keys to the single family operator who also lent me the money. So that was a gut punch. Thankfully though, I had what I talked about in my networking event, so and I started to get some confidence to understand the industry works. I had surrounded myself with people that liked me and that I liked, and so this loss, I knew I was gonna be able to overcome. So this was actually nothing compared to the networking event. That is 100% true, but still hurt, believe me. So this is one of the reasons that I like to invest with top tier operators. Still on the same example, by the way, just to put some numbers. A lot of people don't calculate the returns to the sponsor. And this will paint a clear picture about why I like to invest in syndications in terms of the level of sophistication on who you're relying on. So let's say you take a $10 million property that requires $3 million of equity. So a standard kind of 66% loan to value. The waterfall is an 8% preferred return with a 60-40 split. And let's say that property has the potential to produce a 20% property level ROI during the 7-year hold period. So 20% annualized at the property level prior to the split, and we're calculating the sponsor's return. So you take that 20% property level return, Take away the preferred return, that's going to the investor, and you're left with 12% annualized. 40% of that's going to the sponsor. So that's 4.8% of the $3 million that person raised, which is $144,000 a year. And you do that every single year, the sponsor stands to gain $1 million. Now, what kind of talent can that attract? What kind of people, is that worth someone? Like, do you think you can find a multi-generational family that's been doing this over and over again and has done this for 30 properties that really is worth your trust? That's the type of people that I really like to invest in. And of course, they can bring a lot to the table. They've got industry best practices. They've got software, third-party data, relationships. A lot of this conference will focus on the panels about some of the operational side of things. What do you do when this goes wrong, et cetera? But when things go wrong, when those 2010 situations happen, it's not about who knows the best strategy. It's about who you can call to help you. Who can you rely on? What lender's going to give you flexibility? Those types of things. So relationships are very important. Large co-investments, of course. And this is something that I don't think gets talked a lot about, but it's really important. When a sponsor buys a property, let's use that $10 million purchase, for example. They're getting a $7 million loan. It's very common that the sponsor will need to provide and show the bank that they have at least $7 million of liquidity, meaning in cash or in the stock portfolio. And they have to sign a document saying, this is a, quote, non-recourse loan, but if something goes wrong, if I'm found guilty of a bad boy act, gross negligence, fraud, willful misconduct, then they can pursue me for that $7 million. So that is a huge incentive alignment tool. That's very, very different than that property manager I was talking about previously. Internal checks and balances, just institutional quality stuff. So that was kind of my second big learning moment. Now the third one isn't really that financially devastating, but it was a huge moment for me in terms of my perspective on investing. So this is an excellent opportunity I really like. I would invest in this deal today. It was actually a retail center, and I know there's a lot of interesting conversations going on with retail right now, and I'm actually very interested in the sector. We've got a panel full of guys that are really knowledgeable, but usually when people are scared, I'm super excited, so my eyes are paying attention. So it was in Houston, $8.4 million purchase price, 8.44 cap rate, again, super desirable. This is back in 2014. It was built in 2008, relatively new build, 93% occupied, 13 tenants. I mentioned the tenants because in retail, office, industrial, the number of tenants, I start to feel comfortable around 10. So if you're looking for a rule of thumb, 10 or 13. Now that doesn't paint the whole picture. You need to look at the rent roll. In fact, what I like to do is look at the rent roll, try to understand how many of the tenants, what percentage of the cash flow is being derived from tenants that are susceptible to the internet risk and are susceptible to the recession risk. Sometimes there's crossover, sometimes not. It's a good strategy. Just get understanding of the sensitivity of the deal. The property was 30% under market. Now, again, to add some color, when you invest in retail, industrial, office, et cetera, rents don't expire over 12 months. It's usually 3 months or 5 months or 12 months. So when you're looking at a deal like this, even if it's 30% under market rent, it may be the case that after 5 years, you have a tenant that's paid that whole time, and they're 30% under market rent. You're probably not going to bump up the rent by 30%. I mean, that's like you have a tenant that's in place. So don't contemplate that as being your goal to raise rents all the way up to market rates. And your underwriting assumptions shouldn't assume that as well. But especially late in the cycle, people love to be able to sell the dream. So if I can go sell this property when it's still 20% under market rent, the buyer's going, wow, money sign, value add deal, right? So something to contemplate, as an investor. You may buy it knowing that total value creation is not going to take place, but it's good on the back end. Growing and robust market in Houston. So here's what actually happened. The elevator broke within 3 years of ownership, and Hurricane Harvey hit. And this is actually a photo, not of the property, but you guys know how bad that was. I mean, Harvey was, financially speaking, the most devastating hurricane that's ever hit the United States. $130 billion of damage. Insane. The property was insured, but it still took 2 quarters to distribute cash flow. So as a passive investor, you're consistently getting those 7% returns, 8% returns, and then it just stops. And so all of a sudden, the passive investors become not super passive anymore, right? And I understand that, totally get that. Now, if you invest in 10 deals, one will probably go like that. Even if people know what they're doing, this is a great sponsor, great property. I talked about the tenants and the quality of the market, et cetera. But these are real people, real properties, natural disasters, anything can come up. So the question is, how can this be avoided? And so I'm a huge proponent of funds. Now, we recently put out a single asset investment. Very happy about that investment. We'll definitely do more single asset investments in the future. But funds are just a great way to exponentially increase your amount of diversification in a lot of ways. Geographically speaking, property management speaking, risk profile. Risk profile is a good example of this. So most investors want two things. They want predictability of outcome, which is produced by cash flow, and they want higher returns, which are usually produced by value-added strategies. Now, sometimes you can get a deal that has a good combination of both. But other times, let's say you invest in a super stabilized deal. If you're looking at things on a risk-adjusted basis, that can free you up to invest in a more value-added focused deal. And if you can do this within a fund, get the best of both worlds. Economies of scale, of course, creating one legal document, et cetera. So I did some research here to try to find a good quote from someone, like looking up Warren Buffett, Carl Icahn, something. I found this quote: "Even ethical people can have their vision clouded by improperly aligned incentives." Does anybody know who said that? That's funny. It's actually me. Maybe I stole it from him. Real estate legend Hunter Thompson / Charlie Munger. I don't know. I'm not going to split hairs here. All right. So in the institutional space, there's a capital call structure with funds, and it typically works like this. And the reason I mentioned that, by the way, with incentive structure is that when you entrust a sponsor more significantly, you're basically giving them a blank check in a fund. So I want to talk about ways to mitigate that. One of them is the funding mechanics themselves, okay? So in the institutional world, you typically have an upfront commitment that's legally binding. And the way this happens is, let's say you want to invest $100 million or something. The operator has 3 years to call that commitment due, and they call it in increments of, let's say, 25, 10%, something like that. In the accredited investor space, the passive private owner space, this is kind of our world, 3 years is a long time to wait. We actually have this $50 or $100 or $200,000. We want to get that invested quickly. So this model doesn't really work. It's much more for the institutional space. Investing increments of, $5,000, for example, it's quite a burden as an investor to wait 3 years and say, okay, 10% of your committed amount is due. It's just kind of administratively very challenging. Now, another way that a lot of companies have started to do this, they want to include the fund model. They have a rolling capital call structure. So this is when a sponsor accepts capital into the fund consistently, all right? Basically, if you want to invest $50,000, great, we have an open fund, we'll accept your $50,000. That $50,000 in a bank account, and we'll have a new deal, and that $50,000 will be invested. And that's really how it works. It only is appropriate, in my opinion, if you're doing a lot of deals, because you don't have a lot of lag time between you receive that money when you start to conduct due diligence on these other deals. Because like I said, and Charlie Munger, if you have that money sitting in a bank account, even the right people that you want to make a bet on can start to feel like, man, we're not usually investing in this market, but we can kind of make it work. That's not really what you want to do. So you want to limit that as much as possible. And this is very common in the mobile home park sector because of the fact that funds have more deals in them, because mobile homes themselves the purchase prices aren't as high. So let's say you raise $10 million. You may purchase 10 properties. As opposed to multifamily, you may raise $10 million by one property. Does that make sense? Okay. So we created something for our funds called the property-specific funding schedule. So basically, we establish a wait list. Let's say it's upfront $3 million sitting in a wait list, not sent to the bank account. Then the next property that's under contract, set to close, we're purchasing that property. We call only $2 million of that wait list due. Let's say the property only requires $2 million. Now, $2 million comes into the fund. We use 100% of that to invest in that property. And the additional $1 million of the investors that got in later to the waiting list sit on a waiting list. I like this because I don't want to feel like I'm having my vision clouded, basically, right? I don't want to rely on the ethical behavior of people. I want to rely on them making the best decisions with the clearest vision. That 1 million is kept on a waiting list. And then in the event that we do find another property, it's put under contract, we then accept 100% of that in. You see, so now the investors get to invest 100% of their amount, but we're still not doing the capital call structure, etc. From my perspective, this is good if you're doing, let's say, one property a quarter, something like that. So if you're a real estate entrepreneur, raise your hand if you're here to do some sort of real estate entrepreneurship, either as a side hustle, as a full job, whatever. So if you want to use a fund like this, you can do it. We spent $100,000 figuring this out, so there you go. But if you're an investor, start thinking about that as well. So again, a lot of diversification, 100% of the investment amount, reduces challenges with incentive alignment, and I really like it where 1 to 3 properties, 3 to 5 properties, and we spent a lot of money figuring this out. I've done many, many PPMs. Now, when you invest in funds, though, it's important to understand the template, because again, if you're a passive investor and you're giving your $100,000 to an operator, you don't want them to just have a very, very flexible thing where they can invest in retail, they can invest in development, they can invest in cannabis, whatever. Understand the fund template. Here are some of the things that I like to ask for as an investor. The acquisition criteria, the thesis, the markets. Here's a good question. Especially late in the cycle, I'm trying to limit the amount of unknowns, the amount of risks. So a question I like to ask is, are you investing only in markets that you've already purchased assets in, or are you going to be exploring new markets? I'm not saying that I won't invest in a property in our fund that's investing in new markets, but it's one thing to understand the market dynamics, okay? We've got someone from CoStar here that's going to talk about just incredible data. It's one thing to have that data. It's another thing to have the relationships in that market already. Oh, good, we already know that property manager. Because a lot of these sponsors, they'll go into a new market, hire a property management company, not like that property management company, hire another one, and the third one they love. I want to know on a risk-adjusted basis where they are in that spectrum. So it's a really important question to ask. Again, I'm not saying that I won't do it. It's just for my own internal understanding of the risk of the deal, I want to have a thorough grasp of that. The strategy, the management, of course, what the cap rate is, and then again, the debt. So if you're a listener to the podcast, you know I've been harping on this and I will continue to do it. I don't think enough people talk about it. Probably 99% of all the problems in real estate, the real problems, the loss of principal problems, they come from debt, okay? Think about all the problems that you've heard about your uncle that lost money. The interest rate went up too high. The property needed to be refinanced. I couldn't refinance it. The loan came due too quickly. These are all to do with debt, and it's the majority of the capital stack. So you should focus your due diligence accordingly based on those two things. When people hear debt terms, here's what they refer to, right? The interest rate, loan to value, the loan term, amortization schedule, IO period, DSCR. If you're not yet familiar with those terms, talk to me afterwards. Be happy to kind of explain why they're all important. But that's like the general idea of what debt terms refer to. However, there's more to it than that. A good example of this is, who is the preferred lender? If you're investing in a fund, is all of the debt going to be provided by a government entity, and you already have deals that you've done with that entity? And do they have a very specific criteria of what they will lend on? Again, just reducing those unknowns. If you're contemplating investing in something like senior living, a very important example, that's a very complicated asset class with nuances, the likes of which only professionals understand deeply. So what does that mean? If you have a lender that's like, great, I'll try my hand at senior living. If something goes wrong at the property level, they're not going to understand the nuances of the business. They may freak out. They may call the loan due. I want to be with a lender that has dedicated time, has an arm specifically focused on senior living. If I can, I feel much better about it, basically. And of course, the anticipated spread between the cap rate and the interest rate, which going back to my second example, almost cost me $50,000. Break-even occupancy, I think, is really important as well. Okay, so those are a couple of things. The debt terms, the standard ones that people know about, and then some other that maybe take an extra level of depth, which I know that you guys are all here to kind of learn about. Okay, so in summary, how I turned my biggest real estate investment losses into a $90 million portfolio. Number one, emotional challenges, they cause a huge amount of business failures. It's really can't be understated. Think about the timing of the market, right? Oh my gosh, all the tailwinds that are about to just take off. And I almost missed it. So just keep that in mind. And I'll circle back to that in a second. Embarrassing things happen. That's, by the way, why it was challenging for me. I was super embarrassed. It cost me $100 to rent that room, but it almost wiped me out. Business initiatives fail, just don't quit, okay? That's the truth of how this happened. I also really love to invest alongside top-tier operators who stand to gain or lose millions, because the lose a million part is really important. Talk about signing the bottom of that loan personally. Diversification is key. funds are an excellent way to diversify, but you need to understand the funding mechanics and understand the investment template. Just constantly ask questions. You'll start to learn more and more and start to be more comfortable with how things are structured. Just want to circle back to this. Don't give up. That's really the thing. I'll do an exercise. Okay, everyone, I know we're kind of sleeping now because it's like the second session. Everyone do me a favor and put your chin on your right shoulder. Now everyone do a favor and put your chin on your left shoulder. Everybody you just saw, none of that almost happened because of how close I was to folding. So don't do that. I'm specifically talking to two people right now, two types of people. Number one, someone who's new and an up-and-comer and hasn't yet gone through one of these, and now is going to feel a little bit better once they do. And number two, someone that is going through one of those right now and is like, man, I don't even want to go to a conference. Number three, someone who's been through that and knows exactly what I'm talking about, right? And now made it here is, okay. Awesome. All right, guys. Thank you so much. Appreciate it. We'll bring Dave up.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.